Now let's talk about internal controls for cash disbursements, cash going out. There's a few things that we need to keep up with here. First, we want to have any anti-theft safeguards. We want to make sure that we're not getting stolen from as the cash goes out. So first, we want to require all expenditures to be made by check. Again, in order to get checks cashed, you have to endorse them. We have the paper trail. So it does give us a layer of security there. Another one is we want to deny access to the accounting records to anyone other than the owner who has the authority to sign checks. Again, that's just protecting what we have so other people don't know exactly what we have. They don't know exactly what they can get into. So again, it's just, these are all layers. The more you put in there, the more layers, it makes it harder for somebody to steal from you. Another thing that we can use is what's called a voucher system. And this is predominantly used for when, like, especially with travel. And this is a set of procedures and approvals designed to control cash disbursements and the acceptance of obligations. So a lot of times when you have to go to a business trip, sometimes your business will say, you know what? We'll give you a lump sum of money now, and you use it when you go to Vegas for whatever, and then you just bring back whatever you have left, and you don't have anything left because they gave it to you up front. But a voucher system is a little different. A voucher system is more of the approvals of. So with a voucher system, what happens is if you've got to go to a business conference in Vegas, you say, hey, you go to your boss and say, hey, I need to go to this conference, and they approve it, and they approve what it's going to cost you in terms of airfare, hotel, conference fees, and all that kind of stuff. And once you get that approved, then you go to your conference in Vegas and you spend your money up front, and then you bring back all the receipts, and then they pay you back or they reimburse you with that. So it's a little bit more secure in the sense of they're just not giving you a lump sum of money to begin with. You're using your own money up front, and then you're going to get reimbursed for. So that's a very good way to control the cash disbursements as much as possible. The last thing we're going to talk about is something that some of you may be very familiar with, which is the petty cash system, or the petty cash fund. This is a fund that used to make small expenditures that cannot wait for the formal check writing process. If you've ever worked at a place with a petty cash drawer, then you know it's usually a little lockbox with some insignificant amount of cash there. So if you need to go get stamps or cash register, receipt paper, or anything like that, you're just going to pull it from there rather than having to wait for the formal check writing process to occur before you can go get those kind of things. But it is still dealing with cash, so we need to be able to journalize that. So let's look at what it would look like if we're going to record anything that's dealing with the petty cash fund. So let's start by just establishing a petty cash fund. So it says on January 1st, Golf Company established a $400 petty cash fund. So pretty much what we're doing is we're taking it out of our normal cash account and we're going to put it into a petty cash account. So in order to do that, we're going to say, on January 1st, so 1/1, we're going to say petty cash because that account's going up. It's an asset because it's just like cash. It's just earmarked for something. Petty cash of $400. And then we're going to decrease our normal cash account for $400. Now, that's the establishment of it. Now let's talk about how we would record it as things happen. So let's look at the continuation of this example. It says during the month, the petty cashier paid out $185.23 for special visitors dinners, $34 for the visitors cab ride back to the airport, $72.47 for some of the office printer paper and pens, and $29 to ship a package. The petty cashier asked for and received a receipt for each of the disbursements made. That is huge because we want to make sure that we have the documentation of all these things occurring. Prior to requesting for the fund to be replenished, the petty cashier counted the remaining cash in the petty cash drawer and found to have $76.43 left. Okay, so a lot of things going on here. There's a lot of different numbers and things that we're going to have to do. But I want you to understand the petty cash drawer is slightly different than any other system that we use because it's what's called an impress account. An impress account means we do nothing for it or regarding it until it's time to replenish. And then when it's time to replenish, that's when we're going to record it in our journal entries. So if you notice, we're not going to do one of these and then another one of these and another one of these in individual journal entries. We're just going to wait until that line that says prior to requesting the fund to be replenished. That's letting us know that it's time to actually go to work. We're going to actually do one large lump sum journal purchase or journal entry for this account. So let's just go through this from the top. We're going to say that we are the $185.23 for a special visitor's dinner. That's an expense, so we're going to go ahead and expense it. So we'll say, whatever the date is, we're going to go ahead and expense it. We're going to call it meals expense, and for that $185.3. Okay. Then we're going to move to the next one, the $34 for cab ride. Okay. We're going to call that cab fare expense for $34. All right, $72.47. That's for the printer paper. That's supplies. Okay. And then finally, the $29.87 to ship a package. That's a shipment expense, shipping expense, or delivery expense, $29.83. Everything's good there. Okay, so those are the 4 things that we got the receipts for. Now we need to take it out of our petty cash. Now I'm going to, so $400 is what we started with, and it says that the last one that we had $76.43 left. That means that we used $323.57 of our petty cash fund. Now, if we add up the 4 things that we put into our debit, well, there you go. So there's our petty cash. That's how much it went out, okay? If we add up the 4 things, the meals expense, the cab fare expense, the supplies, and the shipping expense, if we add those 4 things up, that's actually going to give me 30. Oh, I went too far. Yeah, well. Let me go back. Yeah, here we go. Woohoo! Let's just do this real quick. That one. Oop, yep, There, yep. There we go. Okay. So we add up everything that we have here. That's going to give me $321.57. Now notice my debit and my credit's not equal. So how do I force it to be equal? I use the cash shorten over. So I'm off by $2. So I'll say cash shorten over $2. Now my debits and my credits are equal. And so I can move forward. Now I can replenish it. So now let's replenish it. I have to replenish $323.57. So the way I do that, I would say petty cash, $323.57, and cash, I'm getting it from cash for $323.57. That's it how you do it in conceptually, but that's not how you do it practically, because all this happens at one time. So really what I would do is, since I have a petty cash credit of $323.57 and I have a petty cash debit of $323.57, I can actually collapse that down and just make it cash of $323.57. By the end of this, the petty cash is still $400. It's just I've taken it out of cash. And that's how you deal with petty cash funds. Thank you.